Hello options traders, welcome everybody. And I wanted to post another video here for everyone based on a post that another trader put in here last week right here in our forum. And he asked, what is hedging, rolling, and morphing? So good questions. Yeah, let's talk about them. Because it's really hard to post any topic or any video on options without mentioning these terms. Why? Because that's what options were designed to do. And so if you are trading options in any capacity, and you are not familiar with these terms, then you are not using them to your fullest capacity. And that means you will not be as productive and you will not be as profitable. So let's take a closer look. What is hedging, rolling, and morphing? Let's start off with a hedge. A hedge is quite simply betting against yourself. And so what it means is that if you have two assets in your account and that as the price of one of them rises, another falls, then they are hedged. They are playing off of each other. So for example, buying shares of stock is an unhedged position because you can make an unlimited amount as the stock price rises, but you can lose it all if it falls. However, if you add a put option to that, buy a put option to protect it, it becomes hedged. As the price of the stock goes up, put goes down, vice versa. And they tend to, not fully, but just partially offset each other. And it will alleviate a lot of the volatility that you're seeing in your portfolio, but in this example, it would still give you unlimited upside. So it's just a hedge. It's a protective barrier. And so whenever you're trading options, we always want to keep our positions hedged in some way. So let's take a look at a little example of what it means to hedge because, and I like to do this because a lot of times new traders say, well, all right, I bought a put option against my stock. I'm hedged, but big deal. What does it really do for me? Why are we doing this? So let's take a look at a nice example of what it means to hedge and why it's important. Let's say that we're going to put you to the test here. You got to pass an exam, and I'm going to make it a really tough grading scale here. 90 to 100, you make an A. Anything else, you just flat out fail. Now, before we proceed, we always have to set a goal, which is true with our trading. What are we here to do? What's our goal? Well, hopefully you see that our goal is to pass. It is not necessarily get 100. That's great if we do, but that's not our goal. So keep that in mind. Let's turn the page and take a look at the exam. Looks fairly easy. You've got a 10-question matching test here. Now, in the essence of time, I'm going to just bang through this quickly. So let's say that the call option, I look over here and I say, oh, that's the right to buy. That's F. Next one is B. I can see that one's A and H and J, I, C, E. Cruising right along. No problems. In fact, I am absolutely certain I have all of them right so far. But now I hit a little bit of a problem. I see question number 9, formula for delta, and let's say I don't know this. Well, can I get some insights by looking at 10? Maybe I know 10. Formula for gamma. Nope, don't know that one either. Well, now it's a really bad problem. Why? If I guess correctly, I'm going to end up with 100 and pass with flying colors. But if I guess incorrectly, I end up with an 80 and I fail. And this is exactly what I've talked about in many previous videos. In risk management, we always want to avoid situations that put us into an all or nothing type of situation. You can make all the money in the world if it goes up, but you lose it all if it goes down. That's kind of an all or nothing situation. That's exactly what we're faced with right here. Pass with flying colors, everything's great, 100%, or just fail miserably. Well, how can we get somewhere towards middle ground? We can hedge it. How would we do it? Well, hopefully you realize that we can choose the same letter twice. Maybe I picked D for answers 9 and 10. Now, somebody from the outside who watched us taking this test might say, hey, wait a minute, that's stupid. You absolutely know that one of those letters is wrong. It looks like we're just being careless. Why not take a chance? Go for the big score, go for the 100. And that's how a lot of people approach their trading. It wasn't part of our goal. That's the point that they miss. Of course, I could have chosen G twice here, would have done the same thing for us. But by throwing one of these letters away, it might look reckless, but it allowed me to accomplish my goal. So, by choosing the same letter, we've guaranteed a 90% and a passing grade. That's good. Yes, it's true we have no chance of scoring 100, but big deal, that was never part of the plan. So the better way to look at this is we sacrifice the 100 in exchange for not getting an 80. That last bullet right there is the perfect definition of a hedge. Yes, we're not going to do as well as we could have if we did nothing, but we're also not going to fall flat on our face either. So for example, let's take a look at a long stock position here at 50. This is the profit and loss diagram. For those who are new to this, there's another video in here called Profit and Loss Diagrams that will explain these to you in detail. But the thing that you want to notice here is that our break-even point occurs at 50, and that's because we paid 50 for the shares, and our red line here crosses 0. We don't make money, we don't lose money if we sell for 50. But more importantly, if the stock price rises out in this direction, we can make an unlimited amount of money. However, if it falls, we can lose everything we have in the position. So notice the symmetry. We can either make 100% of all future gains if the stock price rises, but we are on the hook for 100% of all losses if it falls. This is exactly like taking a guess on that exam and hoping that we guess questions 9 and 10 correctly. You don't want to do that. Let's move to the middle ground and let's hedge this somehow. So for instance, we might buy a $50 put. That changes us from the red line to the green. So how does this hedge the position? What exactly is it doing for us? The first thing to notice is that there is a crossover point. And every strategy comparison that you do will always have at least one crossover point. Some will have more. But let's draw a vertical imaginary line right here. And the first thing you want to notice is to take a look to the left side. Notice that by moving to this green line, that if the stock price falls, we would have been much worse off by staying on the red. The red line sits well below the green and it continues to lose if the stock price falls. We're getting rid of that. Does it come for free? No, it doesn't. Because look to the right. If the stock price rises, the red line sits higher than the green. We would have been better off by staying with the stock rather than purchasing the put. Of course, we didn't know that at the time. It's a hedge. It's exactly like looking back and saying, well, if we had guessed on number 9 and 10 and guessed D and G, perhaps we would have been correct. Well, yeah, looking back in hindsight, we can always say that would have been the right choice. But we didn't know that at the time. And buying this put option right here still allows us to make 100% to the upside minus the amount that we spend on the extrinsic value for the put. So the best way to understand the hedge here is this. What we've done is we have shifted our break-even point a little forward from 50 to some other price. And that's the price of the time premium that we spent for this put. We've increased that premium. We still have unlimited gains that we can make, just minus this little sliver in here that we paid for the time premium. But we did that for one main reason, and that was to get rid of all of this unwanted risk. By purchasing the put, it kept us from failing. Let's take a look at what rolling is. Rolling is a trade that changes your position to a different expiration date and or a different strike. So whenever you hear the term rolling, it always refers to a change in time or strikes. So for example, let's take a look at a broker's platform here. And let's say that we have these July options here. And maybe I've got the 146 strike. If I wish to move to a longer dated option, perhaps August or September or later, I would be rolling out. I'm keeping my 146 strike the same, but I'm just shifting out to a longer dated option. That is a roll out. On the other hand, if I want to keep the strike the same but move the expiration date closer, maybe to June or May, I would be rolling in. So in and out always refer to time. On the other hand, what if I want to keep the expiration date the same? Maybe I want to stay here in July, but I wish to move my strike higher. I want to move from a 146 to a 147 or a 150. That is rolling up. I know, it looks down, but don't pay attention to the arrow direction. Look at the numbers. The numbers are getting bigger, and that is a roll up. And that's true whether you've got calls or puts. On the other hand, what if I want to move from the 146 strike to something lower down in this direction, to the 145s, the 143s? That's rolling down. So again, in and out refer to time, up and down refer to strikes. And of course, we can get into all kinds of combinations. We can roll up and out, maybe up and in, down and out. Of course, if we're rolling down and out, it sounds like things aren't going too well, but that's what it's called. We're just rolling down and out in time. and there's a very good strategic reason why we might want to do that. So let's take a look at rolling and how you can benefit by using it. Let's start with a $50 call purchased for 6. Now the first thing to notice that the call option has this hockey stick shape to it. Doesn't look like that straight line stock position, so it is hedged. So buying a call right off the bat is a hedged position. And in fact, if you look at the video called Synthetic Positions in here, the position of long stock plus a long put is exactly the same thing as a long call. So it's kind of interesting, when you buy a long call, you're really buying insured shares of stock. And in this example here, it looks like we're paying $6 for it, so that would be the maximum we could lose. And yes, it is limited. However, we still don't want to lose 100% of what we have into the position. So let's say that the stock moves up in our favor. What could I do? How would rolling help me? Well, maybe I could swap out my 50 call for the 55. That would be rolling up. I'm going to keep the same expiration date. And let's just say that we can do it for a $4 credit. And I explain why in the Alpha Trader course, why we typically shoot for a $4 credit on a $5 roll, or about 80% of the difference in strikes. But for right now, let's just say we get this $4 credit. If I have $6 into the position off the bat, and I receive 4, I only have a net $2 into the position now. But I still have my call. I still have this hockey stick looking shape, but it's going to bend at 55. It's going to look like this. I have moved from the red line to the yellow. And once again, this is a form of a hedge. When I sat on the red line with my original position, I used to be able to lose $6 right here. But once I shift or roll to the yellow, I can no longer lose 6. My maximum loss is now 2. Doesn't matter where the stock is down here, I've changed from potential $6 loss to 2. However, I still have an unlimited possibility. That yellow line continues indefinitely in that direction, just like the red line did. So I haven't given that up. What did I give up? Well, if you look closely, there's a little tiny black sliver in between that red and yellow line, and that's the time premium that we paid for the roll. So once again, we've given up a little bit, but in exchange for changing my maximum loss from 6 to 2. And the roll would be very easy. Watch what happens. If I initially bought the $50 call, I'm going to be long the 50 call. And that was when I was on the red line. If I want to shift to the yellow, I can do it in a single trade. I'm going to sell the 50 call. That would be a closing trade. And I'm going to simultaneously buy the 55. However, these two trades right here form a vertical spread. That is specifically a short vertical spread. And because it's a short spread, we receive a credit. So in my example, we received a $4 credit, which offset my initial $6 cost. And then when this trade is executed, the long position cancels out with the short, and we're just left with the long 55 call. So in one simple trade of selling a vertical spread against it, you can roll your option position. What happens if the stock continues to move in our favor? Do the same thing. I will roll from the 55 strike to the 60. And now in this case, if I got another $4 credit for it, I am completely shifted above 0. Here's my 0 line. Here's where I could lose $2 maximum on the previous trade. But now that I've rolled up, I can't even lose. The very worst I can do is now to make $2. Think about it. I initially spent 6. I gathered $4 off of this roll here. I got another 4 off of here. So I've created $8 off of these 2 rolls. Combined with my initial 6 means I have, worst case that can happen is I made $2 or 33% of my money. But I still have unlimited gains, as shown by that green line. Did it come for free? No. If we stayed on the red line, it would have been more profitable than either the previous 2, either the yellow or the green. But we did it because we didn't know. And this hedged our position. We did it by simply rolling our option. Here's the profit and loss diagram for a condor, and many of you might not be familiar with this profit and loss diagram or this strategy, but if you look at it, it's telling us that we want the stock to stay certainly between these 2 break-even points, but ideally between these 2 strikes, which are the 50 and the 65. So maybe I've got the stock right here right now and I put the position on, but let's say it starts working its way out this way, and it starts to threaten this short strike. I'm about to start turning this corner and heading into losses. What can I do? I can roll my strikes. And just like I can easily roll my call options up with a vertical spread, I can do a similar thing here by using a butterfly spread. If I buy the 65, 70, 75 butterfly, I can extend this right wing out this way. Could I finance that? Sure. Maybe I could sell the 45, 50, 55 over on this side. And so I would move this wing in. Once both those butterfly spreads are executed, I'm going to get that for about a net zero. The sale of the one butterfly will just about offset the cost of the other. And what I've ultimately done is I have shifted. I used to have as my center strikes right here as the 50 and 65. And what have I done now? I've shifted them one space over to the 65, 70. So those are my two strikes right there, short in the center now, are the 55, 70s. And I did that simply by executing two butterfly spreads. What did this do? Well, the stock used to be threatening this strike up here, and now I've recentered it for almost no money. And in doing so, I now have a higher probability of expiring with profits. And finally, what is morphing? Morphing is when we physically change the shape of our profit and loss diagram. So let's go back to our $50 call here in red. I'm obviously bullish, but let's say something happens and I turn bearish. What could I do? Well, there's a lot of things I could do to flip this around, but maybe I sell the $45 call. And if I do that, I get a nice credit into the account, and I've changed from the red line here to the green. So the initial trade, I could have lost a maximum of 6, but after that, it looks like I could lose maybe 1 just down in here, and therefore I could make a maximum of 4, but the stock would have to fall. I've changed it to bearish. Now, just because I've switched from bullish to bearish, that's not what necessarily makes it a morph. It's that I physically have changed the shape of the profit and loss diagram. I've morphed it. And in this case, I've gone from a long call to a short call vertical spread, which is the same as a bear spread. Here's another one. Let's take a long stock position here at 200. Maybe the stock has fallen down to 185 or so. And we go, oh, I just wish I had never gotten in this position. I just wish I could get my money back. I'm not really looking to make anything, but I just want to get my money back and get my break-even point reduced. Well, I could actually do a stock repair strategy, which is really just selling what's called a 2x1 or negative 2x1 spread against this. And I can shift from the red to the green. And by looking at the two diagrams, I used to have a break-even point of 200, but now it's down here to about 194. So I've significantly dropped my break-even point. I still have an unlimited amount I could lose, just like when I had the stock, but not quite as bad. Ended up with a little bit of a credit down here, and that's why I have a little bit of a gain if the stock price should take off and run. Of course, if I had stayed on the long stock position, I would have been better off. But something changed back here that caused me to change my mind and want to morph this position. I've changed from the red curve to the green, and that's a stock repair strategy. That's a type of morph. So once again, for any new traders out there, or even experienced ones who are not hedging, rolling, and morphing, you are definitely limiting your potential for profits. And for anybody who'd like to learn more about the art and science of options trading, please check out our Facebook trading group, Options A to Z. It's a free site. We'd love to have you join.